everyone, and welcome into crushthestreet.com. I am Kenneth Amaduri, and I'm joined today with a very special guest, Michael Pento of Pento Portfolio Strategies. He's an expert when it comes to the U.S. economy, market trading, retirement. He's an author, and like I said, he's the president and founder of Pento Portfolio Strategies. And it's an honor to have him on today. We're going to be discussing the markets, precious metals, stocks, what's going on in Davos, and just whatever's on his mind today. Michael, thanks for coming on Crush the Street with me.
Thank you so much for having me on, Kenneth.
Well, let's start off here. I feel like investors, especially when it comes to overall sentiment, really brushed off, the quote unquote World War III. Obviously, we didn't get anywhere close to World War III with this Iranian skirmish that we had. I mean, it was a non-event, but I mean, in the moment, I just felt like people are used to war at this point and used to shrugging it off. But, if we look at what's going on with this coronavirus, I feel like investors don't know exactly what to expect. Is that kind of why we're seeing markets a little bit shaky here? Does it have to do with this virus that is in China and we don't know how bad it's going to be?
Well, first of all, let me just tell you that the market has a levitation act going on, and it's ignored the very salient potential of World War III. Didn't really care about that. Then China shuts down, I think, 13 provinces and growing. It's like, if the United States shut down New York, Chicago, Los Angeles, and, GDP was already only growing at 2%, 2.1%, the way the BEA measures it. But if you actually calculate inflation correctly, it'd be closer to zero. And then they shut down all of the major cities in the United States. And then the market went up. And you have to ask yourself, well, why is this happening? And, we are having a bad day today. The recording is on This recording is on Friday afternoon, early afternoon. And the market's down, the Dow's down about 400 points, about 1.5% of the S&P 500. But you have to ask yourself, well, what, really, we're not in a panic condition here. Down 1.5% isn't a panic. So what are the factors going on here? And it's very clear. The global central banks, nearly every central bank on the planet, virtually every one, has reached the end of its fiscal and monetary role. And they are almost universally all engaged in some form of ZIRP or NIRP and or QE. That's a fact. So much so that there's $500 billion worth of corporate debt around the world that trades below zero, not sovereign debt. Sovereign debt is about 13 trillion. I'm talking about corporate debt. Corporate debt that you are guaranteed to lose money on in nominal terms, and even more so in real terms if you hold to maturity. So basically, is that investors, unless we have a salient credit crisis or a guaranteed recession/depression, investors are just piling money into stocks. And they don't care if perhaps there's going to be a Shiite-Sunni war globally in the Middle East that'll spread to Russia. They'll drag China and the United States into it. They don't care about that. They really don't care unless it's actually happening. They don't care if China, which, by the way, they had a printout today of their manufacturing growth, 50. There is no growth in China in the manufacturing base. And China, arguably, is either the first or second biggest economy on the planet. So there's no growth in China. And they're shutting down. That was a reading from the quarter before. So now we have this quarter where they're shutting down cities, and God only knows how long this virus is going to last. If it's going to mutate, if it's going to cause problems in Russia. I know Russia had an occasion of an outbreak, and it spread into India. It's in the United Kingdom. It's even in the United States. So there's no particular country that's safe from this. So how long is it going to shut down the global economy that's already very anemic? And how does that affect asset prices, which are in and far beyond the Twilight Zone?
Well, You know what's interesting, and I was kind of alluding to this in the beginning when I was talking to you pre-interview here, is kind of the discussions that were going on at Davos and talking about this Twilight Zone. I mean, a lot of these conversations that we've had for a number of years, and we hear about, not in the mainstream, but the CIO of Bridgewater calling the end of the boom bust cycle.
Yeah.
Scott Bernard talking about a bubble to bubble monetary policy Ponzi scheme. And I mean, it's just interesting to hear it on such a grandiose platform, what we've been warning people about for some time. And I'm just shocked they're not trying to maintain the status quo, everything is rosy, a little more, just based on what we've seen throughout the years. They're actually talking about serious problems in the system, which again it was an interesting take from what we've seen at Davos.
Okay, so Scott Minerd, I think is the person I think you're referring to, but I might be wrong about that. And he's generally very, very good. I listened to him, but I was very surprised to hear about the gentleman, the CIO from Bridgewater, talking about the possibility that we would have no more credit cycles in this world any longer. And the predicate there is that, like I just said, that interest rates are already at zero, so they can't lower rates anymore to bring about a boom. And also, in 2018, we had this global try, I call it, an attempt, a failed attempt at trying to normalize monetary policy. So Japan never really tried it. They're hopelessly lost. But the ECB under Mario Draghi said that he was thinking of raising rates sometime in the near future, and it was gradually tapering his QE. The Fed raised rates 9 times. It ended QE, raised rates 9 times, and actually drained its balance sheet from $4.5 trillion to around $3.7 trillion. And then the world fell apart in Q4 2018. I know a lot of people like to forget about that. I don't. I modeled it, I predicted it, and I actually profited from it in the portfolio, the inflation, deflation, economic cycle portfolio that I run. But most people lost between 25 and 30% in Q4 2018. And it caused the Fed to go from, hey, we're going to run our balance sheet drawdown in the background. It'd be like watching paint dry, grass grow. You'll be completely bored by it. And we're going to raise interest rates from, at that time, it was 2.75% to 3.5%. So above what they thought their neutral rate was, or R star. Another asinine made-up concept from a central banker. So then in January, if you remember in January, this all changed. We're not going to really raise rates anymore. We're actually going to eventually cut rates. They actually did that 3 times. And we're also not only going to stop draining our balance sheet, but we're going to add to it. And they're now in the middle of QE. I don't care what anybody calls it. There's no debate. So when a central banker permanently monetizes treasury debt, you are engaged in QE. I don't care if you're not buying coupons, if you're only buying bills. You're deliberately manipulating the yield curve. This time, instead of bending it down and trying to lower borrowing costs on the long end, you're trying to make the spread between the 210 treasury notes wider. You are also engaged in increasing your balance sheet. Yes, you are in QE. That boosts asset prices, $60 billion a month. They're doing QE right now. They also have this repo facility. It was about $300 billion, and now it's slowly attenuated down to $250. So this repo facility and QE is supposed to begin to be wound down in earnest starting in April. So April, May, June. That's what Jerome Powell said he was going to do. Also, Jerome Powell also raised the interest on excess reserves by 5 basis points. Very minor adjustment to the monetary policy. Actually is intended to raise the Fed funds rate to more than the middle range between the low end and the high end. So I don't think it's ever going to happen. I mean, I really doubt, especially given this coronavirus, that the Fed is going to be even remotely able to tighten monetary policy. I think all central bankers are caught. They're at the end of the rope. They're at the end of the line. They've borrowed $255 trillion globally, 330% of GDP. There's nothing they can do more significantly on the fiscal side. Monetary side, they're at zero or below in most cases. We have just 1.5%, 150 basis points before we're at zero. And like I said, they're all engaged in some form of QE. That's the status that we have right now.
Michael, let's shift over to an article that got posted. I see here on Zero Hedge, the entitled "Pento $1 trillion Stocks and the Imminent ETF Disaster." One of the things that you talked about, which I thought was very interesting, was the behavior of bull markets and what happens to stocks and how capital concentrates on a handful of stocks at the end of bull market cycles. And you pointed to, the early 2000s and, that some other times in history. And
50-50.
Yeah, exactly. And so if you add up the market capitalization of just four stocks, Google, Apple, Microsoft, and Amazon, their combined worth exceeds $5 trillion. Maybe you can give us some understanding as to why this happens in bull market cycles. Why does capital flow into just the few, and how experiences blow off top?
Well, I think just telling people to buy stocks doesn't really work when you just look at valuation. So right now we have absolute records in the price to sales ratio of the S&P 500 and the total market cap of equities as a percentage of GDP. It has never been higher than it is right now, even higher than March of 2000. And as far as if you look at it in history, it's far and above, off the charts, these two metrics, price to sales, and they're the best two metrics to look at the valuation of equities. The market cap of equities, the valuation of equities as a percentage of GDP, and the price of equities as a percentage of their sales, as a ratio to their sales. So these metrics can't really be manipulated by just buying, taking on debt and buying back your shares, as the PE ratio can be, even though that's very elevated as well. So when you have, it's blatantly obvious, as we said in the late 60s and in 2000 and 2008 and today, when stock prices are so overvalued, people tend to need some kind of story to justify the valuations, because you can't really just look at these traditional metrics and say, oh, things are okay. So when you look at things like, the NASDAQ bubble, the NASDAQ revolution is going to change our lives, and it ended up being so, but there was a price to that, okay? So the story was that, the internet is, you don't have to look at metrics such as earnings or price to sales, because the internet is going to revolutionize the way we do business. And that justified the overvaluation. And today, the housing market, you see what happened with the housing market in 2008. So everybody, kind of crammed into the home prices, the real estate sector. And today we have the phenomenon of just a few handful of tech stocks that are, even though they are profitable, their metrics are beyond the scope and realm of justification. So people crowd into these names because they say, oh, these are names that you can hold forever. They're perpetual growers. And then compounding upon that factor is you have ETFs, and ETFs that mimic these major holdings, these handful of holdings, 5 stocks, and that brings more buying pressure on the upside of the bull market. Of course, the reverse is true when the bear market comes, and ETFs trade at a steep discount to the holdings inside them. So this is a phenomenon that we have. It's replete throughout history and is very indicative of a very old bull market that is about to burst.
Michael, one of the things going back to Davos is Ray Dalio called cash trash. And he did say that gold should
Not today. He wouldn't say that today, Kenneth. But go ahead.
He said, he did say gold should be part of the portfolio. I'd like to get your thoughts on gold, and also silver. Silver seems to just be such a laggard compared to gold. When you look at the gold to silver ratio and what we're seeing with silver, I guess a follow-up question to that would be: is silver losing its role, and are we dealing with a new paradigm for what we can expect going forward with gold and silver and the relationship?
Before I answer that question, I also want to mention that during these latter stages of bull markets, you see IPOs, record amount of IPOs that don't make any money, as is the case today. And also today, 40% of all U.S. listed companies do not make any money, have not made any money over the trailing 12 months. So these are all indicative of a very old and tired bull market. But now you want to just repeat that question real quick that you just asked me? I'm sorry.
Well, I just wanted to talk to you about.
The cash is trash, right?
Yeah,
cash is trash and gold. Okay, so gold and silver. I'm sorry. Okay, so I don't have any silver in the portfolio right now at all, and I have about 10% of my portfolio in physical gold, no miners at this point. And the reason why I don't have silver is because silver is also an industrial metal. Okay, so it's an inflation hedge and an industrial metal. You need both factors together for silver to outperform gold. In a case of fear of deflation and depression, then gold will far outperform silver. And that has been the case, by the way, for most of the time, most of the duration between 2009 and 2020. But I will tell you this, in cases of rising deficits to GDP, in a case of a topping US dollar, and in case of falling real interest rates, get those three factors in place, which we're close to getting all three factors in place at once, then I will increase my position to gold and add miners in the portfolio.
Michael, let's get your thoughts on interest rates. I mean, going back to, this concept that we're in the end of a boom bust cycle where the Fed's backed into the corner on interest rates, ultra low interest rates. What are your thoughts on how this will affect bonds going forward? And I'll throw one more thing at you too. I mean, I was talking with Peer Street, kind of a hard money lending platform. They lend out for real estate. I have some money in that. And they were even talking about how the hard money lending is being impacted by these low interest rates. I mean, what used to be very normal to get 8%, now there's 7%, and it's dropping below 7% on their platform because interest rates are dropping. And so what are your thoughts in general when it comes to interest rates? And is it true that we're just in this endless stimulus phase of ultra low interest rates that will never go higher?
Well, that's the most profound question out there. So we have today the yield curve. Parts of the yield curve are now inverting again. I guess a big component of that is the coronavirus scare. So you see long rates are plunging. The 10 years down to 1.55% as of this recording. It's below the effective Fed funds rate. So the yield curve is inverted. The 3-month T-bill is above the 10-year Treasury. So that's another signal of recession and fear. If the Bank of Japan is buying, half of the issued and outstanding JGBs, and the ECB continues in its QE, and the Fed is buying short-term debt, then the trend is for central banks to continue buying these debt instruments. And on top of that, they just can't seem to get inflation going, at least the way they measure it. And if you have growth absent, so you have deflation or disinflation, an absence of growth, and central banks buying bonds, then you're going to get lower and lower interest rates. Here's the question. At some point, and this is why I manage money actively in the inflation, deflation, economic cycle model. You can't just tell me and sit there complacently and say, well, central banks are going to buy bonds forever, sovereign debt and corporate debt forever, and there will never, ever be a breakout of inflation. I think that is nonsensical. That is a non-intelligent conclusion to derive from that construct. That's number one. Number two is you will eventually probably not only get inflation, but you most likely will also get someday a credit crisis. And a credit crisis does tend to bring people more into the sovereign debt arena, perhaps. But what it will do for sure is blow up the junk bond market globally, a credit crisis. And if that happens, you'll see rates spike on everything that's not being actively purchased by central banks. And if you get a blow up in the junk bond market, you'll see a shallow recession quickly morph into a global deep depression. That I can tell you, based upon the amount of zombie corporations and junk debt, triple B debt. Triple B debt, by the way, in the United States is 50% of the investment grade bond market. 50%. And there is a record debt to EBITDA ratio across the spectrum. CLOs, trillions. CLOs and junk bonds, trillions of dollars. In fact, if you add up CLOs, junk bonds, triple B, it's about $6 trillion, just in the United States, and $6 trillion worth of those type of very marginal bonds, which will go bankrupt and bust. A good percentage of them in a recession can go bad, as compared to just $1.5 trillion worth of subprime debt in 2008. That's how bad it can be just in the United States. But as I said, in Europe, there's $500 billion of negative yielding bonds. What happens when their rates go from minus whatever, minus 50 basis points to 10% in a very relative quick period of time? That will devastate economies and markets like we've never seen before. So until those one, two, or both of those dynamics happen, and you could get inflation and a blow up in the junk bond market concurrently. But until one of those two conditions become manifest, then you have to manage money for the most part in a long strategy based upon factors and sectors that you determine as a predicate of the inflation, deflation, and economic cycle model that I built.
Michael Pento, everyone of Pento Portfolio Strategies. Michael, maybe give us just some closing thoughts here. The biggest things you see coming down the pipe here for the 2020s. I mean, the biggest things to be considering as we enter this new decade, and kind of some actionable ideas for people to leave this interview with after listening to this 25-minute long conversation.
I think the most important thing you can do is to get out of your passively managed investments. You are going to be led to a slaughter like we've never seen before. It's going to be worse than 29. It's going to be worse than what we saw in the late 60s and 70s. It's going to be worse than 87, which happened all in one or 2 days. It's going to be worse than 2008. It's going to be worse than anything we've ever seen before. And the reason for that is very clear. Asset prices have never been higher. Central banks have never gone to these extremes, and debt levels have never been higher. But what a toxic combination that is. And if you're going to be lulled to sleep in some passively managed ETF that's going to hold 5 of the $1 trillion market cap companies, and then tries to mirror the S&P 500, you're most likely going to be, I can't guarantee it, but you're most likely going to lose between 50 and 80% of your money. That's what historically has happened in the past. And you don't want that to happen with your money. And because I'll tell you this, Ken, when that happens, the fix required, which is monetary and fiscal stimuli, isn't available. In other words, central banks are already in QE. They're already at or near ZIRP or NIRP. We already have $1 trillion plus. In fact, CBO said in the United States, our average annual deficit is going to be $1.3 trillion over the next decade if we don't have a recession and if interest rates never rise above 3% on the 10-year note. Now I can't guarantee many things, but I can virtually guarantee that in the next 10 years, we're going to have a recession. And in a recession, interest rates should spike even on the sovereign level because deficits are going to go close to $2.5 to $3 trillion. I mean, where are we going to get the money for that? And if the central bank prints all of that away, like they're trying to do in Japan, what is that going to do for the world's reserve currency? I don't think it's going to be so smooth. So what can I leave you with? Get out of your passive management strategy and at least move a portion to an active manager who has a proven model over the years that can make money in all circumstances, bull markets and bear markets. Because as I said, the next bear market is going to be, in my opinion, extremely brutal and not easily ameliorated because there's nothing much they can do, especially if it's caused by inflation, because the one thing central banks can't fight inflation with is by printing more money. That doesn't make any sense.
Good words right there, Michael. Michael Pento, everyone. Definitely check him out. He's all over the internet. And if you want to take his advice to heart, definitely reach out to Pento Portfolio Strategies. Thank you, sir, for coming on Crush the Street with me today.
I appreciate your time, Kenneth.